All right, Chapter 7, Receivables. So think of a receivable, amount due from another party. What I want to point out is a company must keep a separate account for each customer that we can track how much that customer purchased, has already paid, and still owes. So you want to keep an account for each of your customers showing their account status. All right, here's a sell on credit. July 1, TechCom has a credit sale of $950 to Comp Store and a collection of $720 from RDA from the prior credit sale. All right, look what's going on. July 1, we are going to debit accounts receivable, $950. We've not received that, but it is an asset. We expect to receive it. So therefore, we are going to debit it $950. Under double entry accounting, what are we going to offset that with? $950 to sales. Now, what do we have going on from RDA?
They're making a payment on their account.
They're paying for their account. So again, this is from a prior credit sale. So they paid for it, we received cash. We're going to debit cash, and we must take that out of accounts receivable, because a prior entry would have recorded that into accounts receivable. Credit cards. All right, most companies allow people to pay for services using credit cards. These are your third-party payment systems. Again, think of Visa, MasterCard, or American Express. We're not using credit cards, we're using debit cards. These are your ATM or your bank cards. Why do we do this? All right, it's going to give our customers the ability to make purchases without using checks or cash. All right, we'll even see sometimes stores using specific store cards. Again, this is a way of speeding up payment. It's a convenience option. Could even be a convenience option as a form of extending credit. All right, so July 15, TechCom has $100 of credit card sales with a 4% fee. Now everyone knows that when you go in and you pay for merchandise using your credit card, using that Visa, MasterCard, or American Express, or Discover, your department store does not get that full amount, but they've got to take a certain percentage of that sales and give it to the card issuer. That fee typically ranges 2 to 4%. So here, TechCom has $100 of credit card sales with a 4% fee, and it's $96 in cash is received immediately. So see how TechCom wins here. Customer comes in and they're offered the convenience of not carrying cash and not writing a check. Telecom has benefits from immediately receiving the money. And then it's up to the card issuer to go in and collect that. So on July 15th, we received $96. So I will to debit cash $96. and I have to send $4 up to the credit card company. So I will debit credit card company $4, and again, crediting sales 100. Any questions on credit card?
No.
Documenting how much cash you receive, and again, what amount you have to pay to the card issuer.
Does that credit card expense account become one that you close out at the end of the month?
Would you close it out at the end of the month?
When you do the, I can't remember the name of it. When you close out your temporary expense accounts, does that become one that you include in that?
You could. Because what you're going to do is consolidate it all down. If you had multiple recordings of credit card expense,
Okay.
you might summarize it, you journal it. All right, now, if we were not receive the $96 in cash immediately, but let's say we had to wait, notice what we're doing here is instead of debiting cash, we're debiting accounts receivable. And that accounts receivable, remember, we've got an accounts receivable for each customer. So we would have this accounts receivable, we would be debiting the accounts receivable tied to the credit card company.
In a larger business, if you had multiple credit cards, would you have one credit card expense account, or would you have one for each credit card you held?
One for each credit card account. You know, most companies rely on one card. Well, I was going to say, if you're in a big retailer, you're going to use all of them. But I'm thinking of more of the purchases side. Yeah, you would have one for each card. Even if you were a business that you issued cards for your employees, you would want to keep a separate account for each card.
Okay.
All right, let's assume now. We are going to I'm going to assume out there that some customers don't want to pay their bill. And so we'll refer to uncollectible amounts as bad debts. And there's two methods that we can look at real quick, and I'm going to close on this. Direct write-offs and allowance methods. All right, under the direct write-off method, TechCom determines on January 23rd it cannot collect $520 from J. Kent. Under the direct write-off method, we are going to account for bad debts when it is determined we cannot collect. So at the moment you realize you cannot collect it, you are going to report it on that day. You're going to make no attempt to predict a bad debts expense. You're going to write off the whole amount that you are not expecting to collect. So on January 23rd, you realize you cannot collect $520. You're going to debit bad debts expense for $520. You're going to credit accounts receivable J. Kent. So again, Mr. Kent's accounts receivable account, you're going to credit $520. Therefore, that account is gonna recognize that Jay Kent was who's matching up with that bad debt. Now, one on March 11th, Mr. Kent's going to surprise us. And he comes in and decides that he was able to make full payment to the amount that we previously wrote off. So what are we doing?
They're debiting the accounts receivable and crediting bad debt. They're taking the bad debt and putting it back into his accounts receivable.
Because he paid.
Because he paid.
We're recording the $520 in cash that we received, and we are crediting accounts receivable, his accounts receivable account. Reversing the entry we made previously. Matching versus materiality. All right, under the matching principle, expenses are to be reported in the same accounting period as the sales they help produce. Here you go. Materiality states that an amount can be ignored if its effect on the financial statement is unimportant. So it's immaterial. All right, last thing, the allowance method. At the end of each period, we're going to estimate the total bad debts expected to be realized from that period's sales. Now remember, under the direct method, we make no estimation. We're going to record the full amount. But under estimating, we have two advantages. So again, go back to the matching principle. It's going to record estimated bad debts in the period related to the sales. And it's going to report accounts receivable on the balance sheet at the estimated amount of cash to be collected. Under the direct method, we do not estimate. And we record on the date that it is believed to not be collected. So therefore, I could be in quarter one, make a sale on credit. Quarter two, realize I'm probably not going to collect this. So I would write the whole amount off. I would have two quarterly accounting periods there. Okay, under the allowance method, I'm going to, at the end of that first quarter, I would estimate what amount do I expect to not be able to collect. So it boils down to the timing and what amount. All right, so TechCom now has credit sales of $300,000 during the first year. At the end of the first year, $20,000 of sales remains uncollected, and based on their experience, we estimate $1,500 of this will be uncollectible. So here's an example of a company that has some prior experience, because they're able to determine based off of past history how much have they not collected in the past. All right, now, under the direct method again, once they realized it couldn't be collected, they would have recorded it then, and they would have recorded, if they estimated that 20,000 couldn't be collected, the direct method would write off that amount. But here we are estimating 1,500 will not be. And notice that we're doing it at the end of the year. And now look at the account that is created. We're going to use an account called Allowance for Doubtful Accounts. Now I introduced this account to you. It's a contra account. We're going to use a contra account. Instead of reducing accounts receivable, we're going to use this contra account. Because at the time that we're making this entry, we do not know for sure who we're not going to be able to collect from. So I wouldn't want to go back into the individual's accounts. I would have no way of going into those individual accounts, receivable accounts. That's a tongue twister. But I wouldn't be able to go back into my particular customer's accounts. Right now, I'm just estimating $1,500 is not what I'm going to collect. I have no way of distinguishing exactly for sure, is it $1,500? And secondly, whose $1,500 is it? What customers does it apply to? All right, we'll say balance sheet presentation for another time because I am out of time. Remember the allowance method and the direct method. Direct method involves actual dollars of uncollected balances. You're going to use the individual accounts receivables of each customer. And you're going to record it at the time it is realized it will not be collected. Under the allowance method, at the end of each period, not at the time it's recognized, but at the end of each period, you're going to run an estimate. What amount am I not expecting to collect? You're going to use that amount. You're going to use the account for doubtful collections. Again, a contra or a temporary account is used because it's an estimate. You don't know for sure. Secondly, you would not know whose individual accounts receivables to offset. Okay.